Good morning, everybody. It's still morning for the next 27 minutes till we hit noon here on the Eastern time zone. It's Friday. Happy Friday, everybody. We will be talking about today what are the best short opportunities out there. And, you might be thinking, hey, Aaron, why would you be looking at short opportunities when we're already down 20%? Well, we're going to talk about that. We're going to talk about how to manage a portfolio in a time that increasingly is looking like we are heading toward recession. We'll talk about today new indicators that show why, or new indicators kind of showing recession looking even more imminent. Today than last Friday or the Friday before that. We had some of the biggest banks, Goldman Sachs, you name it, coming out and saying, basically ditching their S&P 500 forecast by the end of the year. So all these things, not great. Brian's saying shorts are expensive right now. So it depends, exactly what you're looking at. Actually, I would argue that puts right now, with the way that the VIX is still pretty low, relative to how the market's been going down the past couple of weeks. I think the VIX, and we'll talk about the VIX because I think the VIX needs a deep dive right now. A lot of people are trying to play VIX options right now. A lot of people are confused, saying, asking, why hasn't the VIX spiked yet? So we'll do a kind of a deep dive on the VIX. I think Jay Rice is kind of with me on here, but we will. VIX is not low. I'm not saying the VIX is all right. Here, let's just pull it up so we can talk about it now, and then we'll get to the intro. I'm not saying the VIX isn't elevated from like normal levels, but I think a lot of people would have been expecting the VIX to really have this a big spike as the market sells off, and the reason why the VIX isn't higher than it is right now is because a lot of this hasn't really been unforeseen, hasn't been, unexpected volatility. That's what really causes the VIX to spike. If you look at the VIX during, the COVID crash, it was spiking because all of this selling, essentially was unplanned, unforeseen, whereas this drawdown has been very much anticipated by a lot. I mean, you saw it, right? We shared that chart a couple weeks ago of hedge funds being more short, hedging on their short positions more than any other time since 07, 08. In fact, more than those times. So if that's the case, right, if everyone's going short, everyone's expecting a downturn, and then the downturn happens, it's not going to be seen as unexpected. So VIX is at, okay, so we'll look at the VXX right here. Oh, wait, I'm not sharing my screen. That would help. Exactly. Yeah, I think we're in agreement there. I'm saying that's why we would see the VIX spike up during March 2020 is because you had days where we opened limit down because people were just freaking the frick out and had no clue what was going to happen. That's not what's been happening right here. None of the selling we've seen. All right, so this is the VXX on a daily. So this is the short-term futures ETN for the VIX. As you can see, right? Yeah, we've come up a little bit, but in relation, I mean, it spiked up to, this is the VXX again, not the actual VIX, but it tracks it, spiked up to a high of 40 back in March. We're at 19 right now. So people, I think, have been, have had the idea that there's an inverse correlation between the VIX and the market. As the market goes down, the VIX is going to raise. But as you can see here, the market's been going down in this time frame, and the VIX was going down too, because it measures implied volatility. Right, and we've basically just been going straight down. We'll go look at the SPY here too. So people are out there expecting some sort of big one-day sell-off, essentially a bank run type-esque deal where people are like, okay, holy cow, we really got to get out of these longs. And you're kind of, I wouldn't say seeing that in some stocks, but I mean, like Chevron today down 5% isn't nothing. And I do want to talk about the energy names. This, to me, has been the biggest indicator today showing, okay, people are now really, when I say people, I mean Wall Street is now really expecting a recession. Not just, potentially, recession fears are increasing. No, this is saying, to me, this isn't financial advice. I'm not even a financial advisor. Didn't go to, don't have my MBA or anything like that. But I know enough about the markets to know that when you see energy, when you see the XLE down 6% in a day, that's the market saying, okay, yeah, we are expecting a big drawdown in demand for energy, for oil, maybe not just in the United States, but across the world. And you would think that that would coincide with, the VIX spiking up here, which again, it's up 3% today. But in terms of, look, we'll just go straight to the actual VIX from the CBOE, the index. Right, it's spiking up today. I don't know why. I hate my computer. So yeah, looking at the 1-year chart or 5-year chart of VIX, we're elevated from where we were here, but we're still not even to where we were back in April 2022. So we'll see. I think if you're short right now, if you're net short, or if you're adding shorts, you're expecting the market to keep going down, or you're expecting one of these big one-day sell-offs. Either way, you could anticipate the VIX rising further, which again, to my point, was more my point to Brian's comment. Shorts are expensive right now. Yeah. Okay. So the VIX is up actually a lot in the last month, up 50%. But I think the argument, if I were a short, or if I were looking to add to short positions right now in puts, I think argument to that would be, once we get this, the big sell off, once we get the next leg down, we'll see the VIX spike even higher. Right? You're not expecting, if you're going short right now, the VIX to come down. And I personally do think, as long as we're in this downtrend, I do think the bottom will be marked by some sort of forced selling, capitulation-esque event. I know a lot of people are calling for, we'll know we hit the bottom when MicroStrategy goes on, right? All these people are making these kind of outlandish claims about exactly what capitulation point, needs to happen. I don't know exactly. I'm pretty sure the 07, 08 market bottomed on Christmas or something. And wasn't it exactly at 666 on the Spire Dow or something? But I'm pretty sure it coincided around when Bear Stearns and Lehman Brothers and all that happened. So a lot of times the bottom is marked by not just increased fear, but some of these forced selling events to happen. And my point, again, is just that we haven't gotten there yet. That helps explain why the VIX hasn't spiked, even though it is elevated. And I think bears right now, shorts right now, do expect to continue to see that VIX moving higher, which would mean, you're actually getting some shorts at a discount right now if that VIX does indeed move to keep moving higher. And we'll talk about some different hedging strategies. I actually saw a very, very interesting kind of portfolio fund type deal on Twitter. And I'll be honest, have not looked too far into it. So I was thinking maybe at a later segment, we can do that together, kind of look at it, see exactly what this thing is going on here. All right, I'm trying to take some deep breaths to save myself from freaking out at my computer. I really don't. It's frustrating having a computer that just doesn't seem to be willing to work for me. All right, let's go ahead and play the intro. Exciting segment coming up. I'm gonna do this more often, probably on Fridays when the show has a little. Totally disagree to what, Jay? Two shorts get in. I'm not saying, right, I'm buying puts right here. I'm actually not. I'm actually doing the opposite. But I've been asked a lot by different audience members over the past week, like, hey, if I wanted to go short something right now, what are my options? Whatever. So we're gonna talk about that, and I'll talk about why I'm personally not going short right now, and that's why. And Jay, exactly right. I don't want to go short when I already we were already down 20%. The move's over, or I guess it remains to be seen if the move is over. But I don't want to get short, right? Well, the S&P over the last year just went from 480 down to 367. You want me to get short now? After this? No, I would want to get short back here or right here maybe, right? My point was just that, and I'm not the only one out here, or I'm not the only one. This isn't even my thought. Here, we can just go to Twitter and I'll show you, or I'll attempt to show you, because I don't know, I could prove myself wrong here. But the reason why I brought up the VIX and that's is because I've seen a lot of people talking about, buying calls on the VIX, getting ready for the VIX to pop up eventually at. See, look, first thing that pops up, where's the fear at? Oh, and this is actually interesting too. So the futures market expects the VIX to keep falling. This is the VIX futures market from CBOE. The VIX futures market expects the VIX to keep falling until December, and then we get a spike up there. So in this case, I don't think this is saying, okay, we expect the market to keep going up here, and that's why the VIX is falling. I think the market can keep slowly going down here, and that's still not adding any really uncertainty or expected volatility to the market. Again, so my point was just basically that I've seen a lot of people long the VIX here, expecting, some huge pop there. And again, my point was, if that happens, then that will actually make those puts more expensive. Not, that they are, I don't know, they're still expensive today. Hell yeah, Dave. We are going to talk about specifically that strategy here in a few minutes, because there are a number of different kind of things you can start doing right now, to help make up for any lost returns, and that's one of them. So definitely we're going to talk about some different kind of strategies to deploy in a suboptimal market environment. All right, guys, so without further ado, let's go ahead and play our intro. Get the show started. We'll be back.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher. So.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. All right, guys. So, let's do this. I've been saying, and I'll pull up Chevron's chart back up. I think the energy trade is actually really simple right here. Because if you look at how much money a lot of these oil and gas companies are making over these, past couple of quarters as gas prices have been elevated and they're normalizing now, it kind of is binary in a way, right? If you think, yes, we're heading toward a recession either domestically or globally, then these energy names are shorts because they're already elevated. It's not like, let's pull up Chevron's chart real quick. We've seen Chevron's chart pull back pretty nicely. I think we're good to go. I'm not sure. I don't know where did AT go. We're gonna do a special segment here, from Benzinga HQ. So here was my point with Chevron's chart. Looking at the chart, we're right here before COVID, 115. You get the COVID crash, brings us down to, I don't know, $50. Stock comes back. Over the next 2 years, you see this increase in demand for oil. Of course, you get the Russia-Ukraine war, spike in demand. Chevron stock spikes up to 173. We're at 145 right now. We're still very much elevated from pre-COVID levels. If you look around, if we see, and again, that's what the market's saying today, Chevron down more than 5.5%, saying a recession is essentially imminent. If you think that is the case, whether you're talking about a recession just here in the US, globally, this is a short, 100%. There will be a drop in demand for energy, for oil, for gas. Chevron becomes essentially an easy short, and you see that here. And I've been saying that. If you think no, if you think, hey, this is a market overreaction, the Fed's going to keep raising rates, but we're not going to hit this full recession type thing where 1.5 million people are going to get laid off, like the Fed is, or the BLS is estimating, then guess what? Energy prices, the supply is going to remain constrained. Prices are going to remain high. And this becomes a name that you wouldn't mind adding, both in terms of for the stock could appreciate and for a nice little dividend. Let's do just need to test and see if this mic is on. I don't know if I'm not gonna be able to know how to turn it on if it's not. Yeah, see if you can come talk in this real quick. I've got my buddy Alan here. We're gonna do a nice little. Hello. No, we're not on. No. All right, let's here. Or give us just a couple minutes to solve these technical difficulties in your nation. Looks like could be Wyckoff distribution for energy stocks. All right, we're getting this mic set up. All right, guys. New segment. We're bringing on. This is going to be something I'm trying to do probably on Fridays when the stream's a little bit more chill, when we're just relaxing, having a good time. Going to bring on different people from Benzinga that have never been on the show before. These guests may range from expert investors and traders. Could range from people who may just, be a little YOLO buying some ETH and Dogecoin. Or maybe they know nothing about investing and we're just going to have a nice little discussion about what people can do as beginners to get involved into this thing that we all know and love, aka the stock market. Hold on, let me check with my man. Enver's got a bumper for you. Let's see if we. Did you put it? Did you play it? I don't know. I don't have it yet. I'm asking Enver right now. If not, here we'll give Alan our very special guest intro. All right, Mr. Alan Arnold, welcome for the very first time to Benzinga Live. How's it going?
AB, what's up, man? Thanks for having me on. This is a lot of fun.
All right, so let's start here. Why don't you start by introducing yourself? I mentioned your name, Alan Arnold. He's AA. I'm AB. What do you do here at Benzinga?
What do I do here? I've been here for 2 years. I run marketing partnerships. That is my focus.
Okay, marketing partnerships.
All day, every day.
All day, every day. All right. So, what is your experience in investing? Have you been, investing for a while? Have you gotten more into it since working here at Benzinga?
Twofold answer. Yeah. So I have a Fidelity account, which is where I have a Roth IRA and a traditional brokerage account. Before starting at Benzinga, just kind of passive investments, mostly in like ETFs, mutual funds kind of thing. Since working here, obviously there's been a roller coaster 2 years, but, have started trading a little bit in the Fidelity account, some individual stocks, opened a Robinhood account for some YOLO stuff, and got pretty deep into crypto over the last couple of years. So that's kind of, yeah, I've been playing around for sure. Got to keep my fingers on the pulse of the market. So
Hell yeah. So
yeah.
I feel like you're a good, kind of a good model for someone who, may be passively investing, right? And then during COVID, over the last 2 years, gotten more into it, right? I think that's probably pretty typical. A lot of people started being like, oh, what's this crypto thing? Kind of started to buy in. So, um, where do you stand now with the market downturn, both in the stock market and crypto? Have you been playing less on your Fidelity, on your Robinhood?
I've mostly held most of my positions, throughout the roller coaster. I'm 40 plus. I've seen this play out, before, right? The markets come back. So I pruned a little bit of just the crazy stuff that I was invested in, but still have some holdings, stuff that I bought, a while back, during the last, 2 years, and also just trying to hold strong and just pay attention. Obviously, I work here at Benzinga. I'm reading our site and our content all day, every day. So just trying to pay attention to the trends in the markets and see what happens. But yeah, that's kind of been my focus.
Yeah. So one thing I'm curious about, we've obviously had this big uptick in people that have been interested in the stock market, interested in cryptos over the past couple years, but also in alternative investments. And definitely crypto could be considered an alternative investment, but it's a very wide umbrella, right? Some people could be talking about buying, rental properties or trading cards. Have you delved or gotten into alt investments at all?
I haven't personally. I want to. I'm kind of looking for the right opportunity on that front, but in terms of my marketing partnerships day to day, like there are more and more of these types of opportunities where you can really invest in any asset class. And it's super interesting. Obviously yields are tough to come by right now in the equities and crypto market. But on the real estate side, there's some really interesting, compelling marketplaces with some great offerings and some great, return on your investments to consider. So, just like anything, and I'm sure you tell your viewers, day in and day out, diversify your portfolio, right? It is smart to think about tucking some money into some real estate or, some art or wine or, whatever, type of alternative investment. But yeah, I'm thinking about some real estate. I think, that's fun.
Yeah, and I think a lot of people out there. I think real estate is like, it's funny. I think a lot of people are invested, like people that have equity in their home. Maybe they're paying off their mortgage. You're invested in real estate at that point, right? You're invested in the housing market. You might not see it as that way if you're just paying, your mortgage off or paying for your home. But a lot of people's wealth is kind of tied to their home ownership. And so if you do see a wide, housing market crash right now, that could be not great for a lot of people.
For sure. That's absolutely something you got to evaluate. But it's interesting. I mean, some of these apps, you can invest as little as like, $100 or whatever at a fractional ownership
Yeah.
of an Airbnb property in Florida.
Or like farmland, or like a lot of these things
Right.
that might not be typically available to the everyday American, I think becomes really interesting. And I think real estate specifically out of the alt invest category is one that gets a lot of attention because people see, other extremely wealthy people invest in real estate. I mean, even if you think about like someone like Donald Trump, right, made a living buying properties and whatnot. It's like, shoot, I don't have, 5 million for a down payment to buy this office building, but I could throw a couple $1,000s into this, kind of crowdfunding commercial real estate thing. I do think that is going to continue to be something that everyday people are interested in.
Absolutely.
So, okay, real quick, because I know we only got like 2 more minutes left. Do you have any questions for me or for our audience about investing in general, about the current market conditions?
No, but I think, my personal philosophy in terms of what I've invested in is, invest, at least this, again, personal philosophy, invest in companies you like, right? That you care about, that you visited, that you understand how they operate, right? I think, that's advice that's been told to me, by a couple smart investors, it's important, right? Invest in what you care about. I think in the long run, that's going to prove successful for you.
All right. Well, just so you know, I appreciate you coming on the show today. It's been a lot of fun.
Absolutely.
We'll have to do this again.
Man.
Anytime you have anytime you have updates. If you see a Slack message from me while we were live on this show, just know it was not from me.
Okay.
I'm sure you can, do some deductive reasoning and figure out who that was. It was nothing bad. I'm just saying,
You were just saying hi to me?
Someone was from my account.
Oh, okay.
So
interesting.
Yeah.
Well, listen, be good. All right. Have fun today.
You too, man.
Thanks,
Enjoy the
guys.
rest of your Friday.
All right, Benzinga Nation.
Smash the like for Alan. Coming in live from Benzinga HQ again. We're going to try to do more of these, maybe probably on Fridays when. Last question for you, AA. Mr. Nathan Guzuski, I think from the Netherlands, wants to know, are the Lions winning this weekend? Nathan Guzuski.
I would bet the money line for sure.
He says bet the money line. ML Lions. AA says Nathan. So just so you know there. All right, guys. Quick rundown for the rest of the show. We're gonna have my guy Erik Invests on at around 12:15. Might have a surprise appearance from Hedge Fund Tips. He's been on Money Mitch before at 12:45. So we got a couple good guests coming up. Till then, we have a few things we got to talk about. We can go back to a short ideas segment. We also, I mentioned this earlier, I found this fund type deal on Twitter that I want to investigate. But I figured, why don't we do some investigating together, some team detective work, really try to get to the bottom of this, figure it out. Because it seems to me I'm getting some like Bernie Madoff type vibes. Like how are you getting these returns in this market environment? Let's see. All right, give me 1 second. I'm getting my I'm getting the links out to our next guest. The last minute guest ad here. How about any big plans anyone's got this weekend? I want to know, have people started with the recession fears, with inflation? Have people started to cut back a little bit? Put a 1 in the chat if you've thought about or been trying actively to kind of cut back on spending, whether you've been forced to or you're just trying to kind of get out ahead of things. Because from what I've seen, people seem to still be traveling, still be doing everything. I do expect there to be a kind of, you see those stats about how credit is at an all-time high. People seem to be struggling to pay off their credit card debt and whatnot right now. I don't know. I'm sure we'll get data from some of the big people regarding credit card spending and whatnot. Alrighty, y'all. Let's go ahead and get my Benzinga Pro pulled back up. I think some interesting... So let's talk about different strategies. And I forget who it was. Dave in the chat maybe earlier. Let's see. Hot Rod saying yes, cut in. W in the chat. Brian Blockchain 111. Angie saying I've been trying to cut back, cut out on non-essentials. So here's where I'm at personally, is that I have been carrying, I think, a little bit more credit card debt than I would typically like. So I have been active, like finding areas where it's like, okay, I'm going to save 50, $100 here. I can throw that toward my credit card bill. Cause I want to be in a position where I'm completely 100% debt free, especially, as we maybe get more into harder positions. Cause otherwise, if you're going into a recession, carrying a lot of credit card debt or carrying a lot of debt in general, you're really not giving yourself much of a safety net. You're really not giving yourself much leeway there. But let's talk about different strategies here. Let's talk about a few different scenarios. Let's say you're like me and your portfolio is down on the year. So I'm not going to, in my portfolio, and I'll pull up the S&P here. I'm not going to start going short now, right? We talked about this at the top of the show. I think, you know, like Jay Rice said, or like DD would say, you're doing it backwards if you're trying to go short now. If you're already down 20% and you're trying to go short now for a hedge and because your portfolio is down 20%, you're probably not going to have a great time. But what are things we can do to start trying to make up some of these returns? So here's a strategy that, again, someone threw. Yeah, Dave threw it in the chat. Selling puts. So a lot of people, with the VIX being, you know, a little bit higher, showing some people are willing. People are willing right now to buy puts, whether they're trying to hedge or whether they just think the market's going to keep going lower. I personally, for this specific strategy, so I think, and I'll break it down both ways. First, talking about selling puts on the overall market, on indices, on SPY or QQQ. So this is a strategy I would be more willing myself to deploy once we get some, you know, kind of conviction that maybe we've bottomed or once we start moving back up, essentially. It's 100% going to happen that whenever we do bottom, we're not going to know in real time. But when we start moving back up, there will be people that are upset with that move, thinking, why are we going up right now? We should be going lower. When that happens, I'll be willing to start selling puts to those people that want to get short the market when we get a little rally. I'm not saying in that sense, once we start going up, that's it, that's the bottom. But I will be there'll be calculated puts, right, where I'm saying, okay, we've gotten a little rally. I don't think the Qs are going to drop 10% in the next 2 weeks. Start selling puts 2 weeks out, something like that. And then you can just rinse and repeat and keep doing that. That's one way. The way I think Dave is talking about is selling puts on individual names. So earlier in the show, let's see, Dave said, starting to sell puts at prices I wouldn't mind buying. So here's what people have to understand. If you haven't, you know, done a lot of option strategies before, options can be scary. Selling options can be even scarier. Especially when you look into it, it'll be like, oh my God, unlimited loss potential, whatever. Not really the case. So what Dave's talking about here is, say I'm looking at a stock like Tesla. Tesla's actually a really good stock to trade some of these options on because it has such great volatility. There's always a market out there for people wanting to buy puts and calls. Say I'm looking at Tesla's chart here. Okay, you know, we bottom right here at 206. Say, and this is not investment advice, this is even how I feel. I actually wouldn't want to do this with Tesla right now because I'd be worried about Tesla falling further than this. But say I really like Tesla long term. Maybe I already have a position in it. I want to sell puts at 206. So when you're selling a put contract, you're selling the right to... Wait. I don't want someone to make a funny clip of me getting something wrong. A put gives you the opportunity to sell at the predetermined price. So if you sell a put, how you close that trade out, or a way to close that trade out is to buy 100 shares of that stock at that predetermined price, right? So if I'm selling the option or no, I did it backwards. See, this is what I was trying to avoid. A put contract, you're selling the right to... I'm going to back up here. Shelly, can someone... You have the obligation to buy. Yeah, basically that's what I'm trying to get at. To get out of the put once you sell it, right? If I sold $200 puts on Tesla and it gets down there, I have to buy it at 200. But you can do that with names that you like long-term and names that you wouldn't mind owning at those levels. Because either two things are going to happen. Either you're right about Tesla and then it's not going to get down there and you're just going to collect that premium and it's free cash. Or you're wrong and you get to own a name that you like at a significant discount from where it is right now. So this is a great strategy, especially in these market conditions, that if you have names, right, everything's working for you. You have people out there that think the markets and these specific names are going to keep going lower. So you have a market for buyers of there that will buy these puts at actually elevated prices, you're selling puts while they're expensive, then you're already in, right? Some of these names have already been beaten down 50, 60%. So, you know, you could say, okay, look, if we drop another 10% and I have to buy this at this level, then we're looking at we're down 60, 70% on this name that I like long. You're in a good position there. Yeah, and again, this isn't I'm not throwing this out there as some like risk-free strategy. In fact, this actually is probably a riskier strategy than just going out and buying common stock altogether. You do this with specific names that you like long term. You know, so and again, Dave, I don't like doing this. I wouldn't like this strategy with Tesla either. I said that when I brought it up. I just brought it up because it's like I don't know, it's an easy one to do for examples purposes. Saying, okay, looking at this chart, I can sell $200 puts. I'm either going to A, make that money for free, or B, be forced to buy this name at $200, assuming this is a name I like long term. Some other names, like you mentioned, you know, Take Two obviously has gotten beaten down with this with the GTA 6 leak. I don't know, man. So here's what I'm worried about is I do think that, and I don't know enough about like the industry, or I do know enough about the industry. I don't know enough about the company to really, I would assume, and this is just me without researching or doing a deep dive into Take Two. I'd assume that GTA 6 is, and you can see it right here, like it has and will have a significant impact on the stock. My worry with this leak is it was very negatively perceived. A lot of people were like, how is this the next generation GTA? It looks the same as GTA 4, which came out 10 years ago, yada yada yada. I fear that the leak will make the company spend more money on this, push out the release further, kind of both bearish things happen in the intermediate, in the short term. And I think that's the market is showing that that's the reaction or the expectation essentially as well. I don't think it's as simple as, oh yeah, the gameplay got leaked, that's it, we're going to be fine. I think it's like, okay, the gameplay got leaked, we got to do damage control here, let's put a lot of more money into this, yada yada yada. So we'll see. I'm worried about Take Two in the intermediate from that. All right. Again, quick rundown for the show. So we're going to have Erik at Evests on here in about 10 minutes, and then we will have rounding out the show, rounding out the week, Thomas J. Hay at Hedge Fund Tips on Twitter. I believe that one's still a little up in the air. Trying to get it confirmed right now. Take Two is a metaverse play for you. Yeah, I don't know. I don't care what kind of play it is. That my question is the company, is the company's revenue growing? Is it going to keep making money? I'd sell some $55 puts on AMD. Yeah, exactly. That's the type of thing, right? You got to find a name you like, you wouldn't mind owning. And again, you have to buy 100 shares of it. So you have to, you know, understand, like, if I do this with NVIDIA, right? If I start selling $100 puts on NVIDIA, you're looking at $10,000 right there if it gets down to that price. All right, all right, this guy, freaking this kid who we work with will not stay off my Slack. Man, oh man. Speaking of Slack, how's CRM doing? Down 3% today. All right, let's throw this out there to the chat. Knowing everything we know, what is one company you wouldn't mind going long today? Even into a even into a recession. Say we head into a recession, you have to go long one company, what would it be? Not an easy question. How are like the dollar trees of the world doing? Oh my Lanta. God damn. You guys remember back in like here we started looking up what stocks do well in recessions? Uh-oh. Last step, verify your account. How do I get back into my Benzinga Pro? Actually here, you know what we'll do? We can do this. I want to figure out. This is our little this is our Sherlock Holmes segment. Assuming my computer loads. You guys can see this. I'm not just like making this up. It's taking an hour to load like a web page. Shoot, I screwed this up because I think this is someone I follow on my personal account and not on Benzinga's account. It's like unusable right now. Incredible. All right, here we go. All right, so I found this from a woman I follow on Twitter. Username is nope_it's Lily. I believe she's some sort of a sorry guys also for that like 45 seconds of terrible show / podcasting. Wait, Easy Mike saying, so AB, you agree with me that something was going to break? Wait, did something break today? I mean, the XLE's down like 6%. That seems kind of broken. It's almost like limit down territory, right? Remember when we were at limit downs, down 7% on like the overall market during COVID? I think if we keep heading in this direction, the bottom will be marked by some sort of capitulation event, something breaking. I don't think that is the I don't think that's necessarily inevitable at this point. I don't think it's inevitable that something has to break to mark the bottom. You know, there could be essentially good news that comes out in the next couple weeks regarding the energy markets in Europe or something that, you know, could help give investors some, you know, there's a lot of things, I think, but assuming we stay on the path we're on today, and, you know, we talked about like Chevron and XLE being down 5-6%, showing the recession is seen as pretty much imminent. Then I do think that we will end up seeing some forced selling and some capitulation. But I think a lot of allocators, funds, etc., right? Your Lehman Brothers, your Bear Stearns of the world, especially outside of the crypto industry, I think a lot of them have first seen this and seen this coming. That's like, I'll show that graph again that we looked at a couple weeks ago that showed that hedge funds were betting, were essentially had more short positions than any other time since 07, 08. And I don't think that was just hedging against aggressive longs, because I think a lot of those aggressive longs have been taken off over the past year and a half. So I don't know. I mean, it's like, I'd be very shocked if you told me there's some big fund, investment bank, hedge fund out there on Wall Street right now that's gonna blow up if the S&P 500 goes down another 10%, because I think a lot of them have been expecting this downturn. global recession. Yeah, I mean that's literally what like everything is. That's like why the VIX isn't spike, like it's high to Jay Rice's point. Yes, the VIX is high, but why it's not absolutely spiking right now is because this is kind of the expectation. All right. So here, let's do. This is what I wanted to do some investigating on. Oh my God! Holy shit! Oh no! Oh no! Oh my God! Delete that AT. I just screwed up monumentally. Luckily, there's not that many people in here today. I just shared the StreamYard link in the chat. Can you get on YouTube and delete it? No, I tried. No, there's not an option to in StreamYard. It says either like block user, which I can't do because it's me, or put user in timeout. That was a big screw up. Sure, anyone can join. Hit the link, hop in. I really don't care. So it's out there now. It's public. One time someone did that back when we used to have like 1,000 people here every day. Someone shared the wrong link on Twitter and there was like 80 people in backstage trying to get in. All right, so this is what I wanted to do some investigating on. This is a portfolio. As you can see, it is half in NTSX and half in AQMIX. Wisdom Tree US Efficient Core Fund and the AQR Managed Future Strategy. So I'll let you guys know. I'm bringing this up to you guys. I'm bringing it to your attention. I have no clue what either of these funds are. I'm going to assume this AQR Managed Futures Strategy is some sort of covered puts strategy that minimizes risks to the downside. Either way, this is the portfolio performance over the past 3 years. As you can see, let's go to January 2021. This is January 2022 is kind of where the market topped out. This thing's still going up. This thing's been going up in a straight line. This is what I said. I'm getting some Bernie Madoff vibes. How are you getting these returns in this market? I don't know. I want to figure it out together. Again, I don't really know too much about Nope. It's Lily, the woman who shared this. She's the chief investment officer of Novi Lauren, it looks like. She's some sort of trader. Got a decent following, a lot of followers. So here, let's give her a follow from the Benzinga account. But let's go back real quick. I want to figure out exactly what these things are. Let's start with NTSX. And there's also, keep in mind, some sort of like auto rebalancing between the two funds in this portfolio. So again, I'm not exactly sure what these funds are doing or really where they're from. It looks like the NTSX is from Wisdom Tree, AQMIX from AQR, I guess. I'm not exactly familiar. But either way, some sort of advanced options, future strategy going on here. But if these, okay, by the way, this is a longer history to 2011. Okay, so showing that this strategy did come down a little bit, but still, worst year down 14%, best year. So okay, let's see what. Oh no, this is a different. This is slightly different portfolio. Let's go back to the original one though. NTSX. Wisdom Tree Core Efficient Fund. Read about it. Seeks total return by investing in large cap. Okay, so this isn't the NTSX seems like just kind of a normal AQMIX. Or here, let's look at, so this is from Morningstar. But let's look at it straight from AQR's website. And I do see our first guest hanging out backstage, so we'll just look at this for about 30 more seconds. We'll bring our first guest on, talk to Erik at ES Invest on Twitter, see what Erik's been watching since last time we had him on a couple weekends ago. Okay, so alternative approach for building better portfolios as part of a strategic asset allocation. Managed futures has the potential to improve the long-term return and risk characteristics. We invest in over 100 liquid futures contracts, futures related, utilizing short and so. Okay, essentially, this AQR funds is actively managing this futures fund. AQMIX has had pretty good returns over the past couple years. We'll go back to that original tweet showing you what caught my attention was just like, yo, I haven't seen too many portfolio charts that look like this over the past 2 years. And guess what? 10,000 from 2019 to 20,000 in 2022, a little bit over 100% in 3 years. You can say, hey, Aaron, that's not like the most insane thing I've ever heard of. You're right. It's not. It's not, oh my God, like whatever. But in this market environment, it is. Getting 100% over the last 3 years, or at least over the last year, still going up is significant and impressive. But all right, guys, let's start by going ahead. Our Erik shared with me some good insight. He might have some thoughts on that fund. So without further ado, let's give Erik our very special intro. Bring him on the show. See what he's doing. Erik, how you doing today?
What's up, my dude? How's everything?
Good, man. Sorry about last week. I know we got kind of crossed up on schedules and what, or not.
Dude.
We were supposed to have you on the boot camp on Wednesday.
Totally cool. I'm actually super supportive of the whole boot camp thing. I'm doing one right now on the YouTube channel called the Outlier Trading Boot Camp. So any use of the term boot camp, I'm all about it. It's just super fun.
Yeah, I mean, you've got the military background, so you get to blend your interests, right? You've got the boot camp mixed with trading. It's perfect for you.
Yeah, which is funny because for the longest time I was like very anti doing that, just because it's this fascinating thing when you're in the military. The cool thing is to kind of pretend you're not in the military. And then when you're out of the military, you're supposed to pull more of that experience into your real life. So it was actually the suggestion of a few people that they said, hey man, like you need to do this. So I was like, okay, fine.
Yeah, so I love that you're doing it, by the way. I think it is a fun way for people who are like trying to get into investing, like the idea of, okay, I can attend this workshop for one day and kind of go from 0 to 100 in my understanding. As you know, though, right, it's one thing to learn the basics. It's one thing to kind of master this stuff. And I think, you and I would both say we're still learning, still, picking things up. It's kind of an ongoing process. Do you have thoughts on that? That AQMI? I saw you posted something about it in the private chat. Like, what are your thoughts on funds like that in general that kind of use these advanced strategies to try to maximize returns?
They're fascinating, and they're actually really, really cool. Some of them, if they're structured properly, can do well. So I'm actually familiar with that one. That's futures based. There's a couple others that I've looked at over time. I don't know the tickers off the top of my head, but essentially they use things like covered calls. And essentially, instead of the investor themselves writing the covered calls or the covered strangle, essentially a fund does it. So I think that there's something to be said for that. The tricky part is like when you look back at back testing, it is so freaking important to either uncap upside or lever. Otherwise, you essentially, if you're just writing covered calls, those typically will underperform the market, especially during bullish markets.
Right, so, and that's what I worry about. Like I can look at that picture of the fund that I shared and be like, oh my God, it's been going up the last year, nothing else has. I'm going to invest in this, and then all of a sudden, it's underperforming the market for the next year.
Absolutely, and that's the name of the game with those things, man. Like they're good when they're good, they're not when they're not, and unfortunately, like I think back tests are really useful to create a data set that we can analyze. But beyond that, who doesn't look like a genius in a back test, right? But
right. And go ahead. Sorry.
No, I was just thinking like they have a sneaky way of making things look absolutely rosy and beautiful. But at the end of the day, it's not exactly direct translation to the markets.
Yeah, and I think there have been a lot of like in-depth studies of back testing of market strategies, and they come to kind of different conclusions, and it's kind of controversial. And I think like if you if someone was trying to sell you a course or something, they said this strategy has been back tested, that's kind of a red flag to me. Like, honestly, like, so just be wary of whether someone's trying to promote something that's been back tested, or even like I'm talking about looking at this as an individual saying, wow, this fund is amazing. It's been able to get positive returns when the market's down, investing in it. And then, like I said, maybe for the next year, it's underperforming the market. So you get kind of tripped up by that back testing.
Yeah, and if that's the kind of risk disposition somebody's looking for, like the all-weather portfolio still exists. It's been around for a long time. It's a fantastic setup. It's super simple to construct. And Ray Dalio did
which portfolio?
The all-weather portfolio.
Okay.
Are you familiar with it?
I'm not actually. I haven't really read too much from Ray Dalio.
I can't say I've read a bunch about him either, but I will say that it is certainly a good read just in terms of how he chose to construct the all-weather portfolio. It's a useful concept because it's exactly what you're talking about. It's normalizing relationships, risk on, risk off assets so that you will benefit in certain circumstances. It will add drag in other circumstances, but overall net positive regardless of market conditions. And, that's, for a lot of people, that's not a bad way to go. But I do think being, too wary of risk, depending on where we're at in our growth cycle, is to our own detriment. Can't be too risk averse. Otherwise, you don't make money, is what it comes down to. Like, a big part of my ability to grow an account early on was being kind of risky, but calculated. So I would lever fairly regularly, but I would always have tight risk control metrics on the leverage.
So with that said, is there a way we could try to implement some of these maybe covered call strategies or covered put strategies into our portfolios in a way that maybe is generating some extra cash for us, but not in the long run really limiting our return? Because I hate the idea of that as an investor.
Absolutely.
I don't want to limit my returns in any way possible. If I'm picking great companies that I think, I want the sky to be the limit. I don't want to limit myself at potentially 10, 15% a year, whatever it is.
Dude, that is spot on. And it's actually super easy to do it. I consider myself like the least artistically creative person on planet Earth, but it really does surprise me when, a lot of people don't think of these small tweaks on a common strategy. So let's talk about the covered call, right? So if you have 100 shares of an equity or a security and you sell one call against it, your max profit is now defined. You run out of deltas as soon as you hit that short strike on that short call. You can't make any more money. But the script starts to change. Let's say you have 500 shares, which is a total of 500 long deltas, not beta weighting or anything, just 500 long deltas. And then instead of selling 5 calls, you sell 2. You don't get as much money up front, but you have a maximum of negative 200 deltas against your long 500 deltas. So it means that you have 300 shares that are uncovered. So essentially, by using a ratio, you don't have to cap your upside. And it's like, I'm vehemently against capping the upside personally, if you really can avoid it. If you want to get out of the product, then sure, no problem with going a 1-to-1 ratio. But I think using the ratio is super important.
Yeah, and that's a great, I think, example of a way right there you can kind of generate some extra cash with these covered calls, but not be net in a position where you're capping your upside. I think going back to the like 1-to-1 ratio example, though, something that, maybe someone could say is like, okay, say I'm long, let's just for example's sake, say I love Tesla and I'm long Tesla and I have 100 shares.
Okay.
What if I wanted to sell covered calls, but at like maybe on a weekly or 2-week basis at a point where I don't think the stock's gonna go up 15% in a week, so I can maybe take some extra cash. But as the stock trickles up, I'm still good on my initial position and also good on my covered call position. What would you say to someone trying to do something like that?
I think it's possible, but I think they're asking for trouble. These in general are the people that try to fight a trade that's doing the best case scenario. So in a covered call, our max profit is above the short strike. That's where we make the most money. So a lot of those people, they get greedy. They want to make another $400 on, the short call, and then they essentially fight themselves trying not to get a sign on the short call. And the funniest part during all of this is you have an unrealized gain on the equity, on the underlying, and you're creating all of these realized losses trying to fight this short call position that's now in the money. So it's doable though, because you can absolutely manage short calls. You can roll them out in time, you can roll them up, and more often than not, you can do that successfully. But people like with that mindset tend to sooner or later get caught when Tesla makes this huge run up. They wanted to make more money, they're now capped, and then they can't, and it's so far in the money they can't even roll it out and up to improve their basis, and then they're essentially pissed off at, again, the best case scenario that they have available to them. So I don't think there's anything wrong with that. What I would maybe flip the script though for them is, instead of selling the call when you have 100 shares, wait until you could buy 25 more shares. Not exactly the same delta ratio, but now you still have 25 uncapped shares as compared to no uncapped shares. Like, you don't have to, you can sell calls against uneven basis.
So your point is basically in that scenario, again, I'll try to.
If not, it'll be a little more damage before they have to finally pivot, but pivot they will. And that's how things are positioned. If you look at institutional investors, they have their highest cash levels since 2009 and 2001. Before that, those were periods where you wanted to be a buyer, not a seller. Recession expectations are the highest since April of 2020. If you remember, the market bottomed in March of 2020. And then before that, March of 2009, which was the bottom of the great financial crisis. So oftentimes, the pessimism is acute because the recession hasn't yet been declared. My sense is it will be declared somewhere around March 9th. And we'll look back and say, oh yeah, we were in a recession, and often the market bottoms well before it's officially declared. So I think that's where we're at, and we've got a little more volatility to work through, but eventually the Fed has to ease up on that language.
Yeah, is March, are we getting GDP data around that time, or why do you say specifically March 9th?
I meant November 9th. It's the day after the election.
Oh, okay. I was curious what the specifics of that day.
I was tied into March 9th being the March of 2009. But no, my sense is it'll be declared a recession sometime after November, after the election, and we'll look back and say that's a rear view mirror event. We'll probably see a third quarter of negative GDP for Q3. That'll cement it. They'll declare it. And then everyone will know the recession's largely in the rearview mirror, and the bottom of the market historically has come before it's officially declared.
Yeah, and we see that all the time, right? And you see that thought being put out there, essentially, that remember that markets bottom before the end of the recession, or during the recession, essentially, not after.
Exactly. By the time they declare it, it's already too late. Yeah.
Yeah, and by the way, I think we're in complete agreement. I love everything you've said, because I think you're putting forward a lot of the same points or thoughts that I have, but probably in a way a little bit more articulately and with a little bit more experience.
Thank you.
Oh, sorry. I just got note we're back on YouTube, because I agree. Like, the Fed right now, and I've been saying this. I've had different economists on the show talking about it. Like, at the end of the day, we've known, or at least a lot of people have foreseen the instance that we're raising rates, but it's not going to do anything to fix the supply side issues of inflation. It's crazy. Like, you look at something like rent right now, or housing prices, it's like we're still in a housing shortage. Rent prices are skyrocketing. Let's make investing in new housing harder to do. It makes literally no sense backwards to me. But again, I just the Fed has one thing in its toolbox, and it's raising rates, so it's going to open its toolbox and do it. Whether it's going to help or not, it's silly. It's annoying to me, because I feel like we can't have a normal conversation about it. There's obviously a lot of politics baked into it, but it's just blasphemous to me, essentially, that the Fed can get away with doing this when it makes no economic sense to me, at least. So it's good. I'm glad I'm hearing this from someone else as well.
Yeah, I mean, look, the supply chain issues are easing up. We used to have 120 ships sitting outside the port in Long Beach. Now it's like 6 or 8. So the supply chain is easing up. These things all work on a lagged basis. And the problem is they're being impatient and not allowing it to work through the system. As far as housing, you are seeing how housing prices weaken. Rents are a lagging indicator. The other thing is that the way rents are calculated, owner's equivalent rent, changed, and it's actually impacted the numbers and made them kind of misleading to the upside. So there are a lot of things, we see it even with commodities, all started rolling over in June. Now we're seeing it at the pump. So these things take time, but consumer confidence bottomed with gas prices peaking in June. So that was the lowest print of 51. I think we're up to 58 or 59 on consumer confidence, and inflation are joined at the hips. If you look at 5-year inflation break-evens, last I looked, they were down to like 247 from 359 just in March. So, everyone other than Jay Powell seems to know inflation is coming down and you need to be patient. Instead, they keep jamming these hikes in the forward guidance. Now, that's the bad news. The good news is talk is cheap. I mean, they've been very aggressive with their talk. They certainly couldn't be more aggressive with their talk. But in the whole scheme of things, today, we're at 3.25 on the Fed funds rate, which is historically low and may be okay. The question is, do they jam through another 125 or 150 before the end of the year? And I just don't think the market and the economy will be able to digest that, because the first of the emergency cuts is going to start to trickle into the economy, and we're going to see an abrupt halt to activity and demand destruction if they keep at this pace. So, it's kind of tale of two cities, Charles Dickens. We'll see what they do next. I think 2:00 today will be an important meeting. If they don't do anything to walk things back and speak a little bit more rationally, then we'll have some more pain in the markets before something changes. But we've been to this movie before.
Right, and that's kind of the good news, is the worse things get, whether you're looking at the stock market specifically or the overall economy, right? Businesses feeling the pain. The worse things get, the closer we are to the Fed having to walk these things back and essentially, start, either not necessarily cutting rates, but slowing its rate hikes, et cetera. So, like you said, we've seen this before. The last thing I'm curious about and wanted to talk to you about, Tom, is on the content side, because I like that you seem interested in, you manage the website and have the newsletter and stuff. Why is it essentially important to you to put this content out there? For most people, hedge funds are very secretive, work behind closed doors, don't get access to a lot of the equity research that funds do. Do you feel you're doing things, I guess, kind of differently than a lot of other firms out there?
Yeah, I think it helps to clarify our own thinking process. When you put things out there publicly, you really have to give it a lot of thought and a lot of preparation, et cetera. So it keeps us constantly sharp, constantly on top of everything that's out there. And, it's the old kind of golden rule, right? If you do good and you put a lot of good out there, a lot of good things come back to you. And we found that to be true, and we found it to be very helpful, and a lot of people coming back and thanking us and learning stuff that they didn't know, and a lot of gratitude. So we continue to do it. As long as people support it and watch it and share it with their friends, we'll continue to do it. And, we'll go from there. But no, we could certainly just sit back and manage our own money and our clients' money and do our own thing. But I think people have gotten a lot of great value out of it over the last 3 years. We've gotten a lot of great feedback. It's continued to grow. So we'll continue to do it.
Yeah, and I mean, that goes hand in hand with our mission here at Benzinga of trying to kind of democratize financial news and information for the everyday person. I personally, I come from more of a media, I went to journalism school, but I've always been interested in the stock market and investing. So this has been a great, job for me, kind of blending my two interests together. But I've thought about personally, well, why don't I just put out some of my research out there, as and seeing it. If people like it, then they like it. If not, then they don't. Would you recommend, people doing that, putting out, if I put out a great research report that outlines a short soybean trade like you did in 2012, maybe someone out there in the ether likes it and picks it up and wants to, do more with that? I don't know.
Yeah, well, I would say be very careful putting out short research publicly. We don't tend to do that. That was done privately to them, because then you get a lot of people shooting against you. But if you do high quality research and high quality businesses that over time are going to work out, and people can withstand some short-term volatility, I think it's a home run. But you got to do your work. You don't want to put out sloppy stuff and that's doesn't help you, it doesn't help them. You have to really know what you own, do the background research, and certainly sharing is good, because at the very least you'll get people come back and say, hey, this is why I think this is what I think your thesis is missing, or have you thought about this? And maybe you'll go back to the drawing board and you'll say, oh, I didn't consider that at all. Maybe I should get out of this position. Let's look for new places to allocate the capital. So it can be a very helpful process if you do it, carefully and responsibly, and really do put the work behind it. But the hardest part is getting out there. It's a little bit nerve-wracking initially, but if you do it, you get better at it over time. And like probably when you started doing your media. I mean, imagine the first time you conducted an interview, you're probably a little nervous, and now you're a seasoned pro. So it's like anything else. You just got to get on the bike and give it a whirl.
Yeah, and I wouldn't consider myself a seasoned pro, but definitely I think I've had improvement since I started doing it. And it reminds me, like, one thing we were taught in journalism school was, like, you don't, judge a piece of an article or a piece of journalism based on the author, the person doing it. You judge it based on the criteria, like you're saying. So, like, someone no name can write a great article and it can be like great journalism. They did the work, like you're saying, actually do the work, versus on the flip side, some New York Times journalist can put out an article that has a lot of inaccuracies in it. So instead of judging it like based on, oh, this firm put out this or this, judging it based on the actual content as opposed to the person doing it. Basically, my thought there is like would some, if I did, say me, and I'm not saying I'm going to do this, but say I did put out 5 great research reports in a row on longs, they all ended up working out, would a fund or someone like you see that and say, okay, that's great, but that kid doesn't have like an MBA or anything, or see that and say, oh, that kid knows what he's talking about?
Yeah, a lot of college kids ask me this. I would say if you're looking in that regard, you're probably better off going directly to the funds that you want to do and present your ideas and developing that relationship over time versus putting it out publicly. Although Michael Burry had a blog in the late 90s, and that's how he got capitalized by
Scion was his own.
Scion, yeah, but he was funded by not Bruce Greenwald, but the guy who does that little blue book that beats the markets, Greenblatt. Joel Greenblatt, I think, was one of his first financiers. He was running the blog while he was, I think, working as a doctor or an intern, and he really put out high quality value research over time. And people will follow you for years. I get people that say, I've been listening to your podcast for 3 years. I want to invest with you. Can you talk to me about how that works? It's good to put out a lot of good stuff, if for nothing else than to consistently sharpen your own skills, put it out for public consumption, get feedback, refine your process, get better, and move from there. But in terms of like, if you're trying to get a job at a particular fund, I would put together your best ideas and send it to the fund versus just putting them out publicly.
Yeah, and I'm half asking kind of for myself, but also asking, I know there's a lot of people in our audience that are like, they're interested in finance, but they don't have the degree and they want to know how they can get involved. But I'll make a deal with you, Tom. So with that said, if I put together some good equity research, I'll come to you first. I'll privately, pitch it to you. If you hate it, turn me down, then I'll go the public route, but I'll give you the first dibs.
Fair enough. Yeah. And I think for people that want to get into equity management and that type of thing, probably one of the things they can do at a young age is start to read the CFA books and really get a background in analysis and the skills of the business that will give them more confidence to make solid presentations and kind of understand the language of the business. So, it's like you have to go to a little bit of plumber school before you go out and start, installing pipes in new home construction, right? Because you don't want to wing it and it can be catastrophic.
You're saying essentially you don't necessarily need to go get your MBA, but picking up a few CFA books and understanding how these presentations and reports work will help you a little bit.
Yeah, well, it's certainly a process, and you have to have the basic skills. So what I say to people, again, start with the intelligent investor right there. That'll show you if you actually want to pursue it or not. That'll save you a lot of time. 2, I would do all the Warren Buffett annual letters. And 3, start to read the CFA book so you have a grounding in kind of the basic language and understanding of analysis in the business if you're going to go the equity route.
Yeah, and like Tom said, the first time you put together an equity research report, probably not going to be fantastic. But Warren Buffett's first one probably wasn't fantastic either. But if you keep doing it, you're going to keep getting better.
Exactly.
All right, Tom. Well, it's been a pleasure to have you on today. I'm glad we got a chance to get you on the show, even though it's been kind of a wacky day with all these tech issues. So again, maybe on a subsequent visit, we'll have a little bit more of a normal show. But man, enjoy the rest of your Friday. Have a good weekend, and we'll chat soon.
All right. Thanks so much, Aaron. Have a good one.
Of course. And real quick before you go, where can audience folks find more from you? If they want to sign up for your newsletter, et cetera.
Yeah, go to hedgefundtips.com. All of our podcast, our weekly free podcast, video cast is there, our weekly research notes, and a lot of great stuff. So check that out. You can also add your email on the website. Just scroll down, enter your email. You'll get our daily email and newsletter. And I think you'll find that very helpful moving forward.
Beautiful. Hedgefundtips.com. Got that in the chat. You can also follow Tom on Twitter at that same name, at hedgefundtips. Tom, again, can't thank you enough for coming on. It's been a great conversation.
Appreciate it, Aaron. Have a good one.
You do the same. All right, guys. Tom Hayes from hedgefundtips.com. Go ahead and give him a follow. Always got to learn more from the hedge fund part of the world. All right, guys. That'll be a wrap for us on this beautiful Friday. Hope everyone has a great weekend. We'll be back live on Monday, as always. Till then, stay green. If you're not green, a lot of us aren't. I'm not today. I don't know. Maybe turn off the computer, go outside, go for a walk. I don't know. But enjoy the weekend. We'll be back on Monday. Like I said, please like the stream and subscribe if you have not already. Peace and love, Zinger Nation. We'll be back.